All right. So
Hello.
since this is being recorded, is it okay if I start now? Or
I'll just do a quick
Alright.
introduction. So, hello and welcome to the partial double octo-finals of Australs 2021. We have UPM 1 against Ateneo 1 debating that we regret the rise of retail investment. I'd like to invite the first affirmative speaker to commence the debate. Here.
all right. Every day as I try to play Sudoku in peace while waiting for personal comments from my judges in between rounds or procrastinating my papers that are due tomorrow, I get pop-up ads for retail investment apps that promise me gift certificates for $100 and all kinds of things that are too good to be true. As the average reasonable person who still lives a relatively comfortable life, I haven't fallen for any of them, but someone who's slightly more desperate than I am after getting laid off from their job or not receiving stimulus checks from the state might do just that, might enter this very risky world of investment, even if there's an information asymmetry that massively disadvantages them at the end of the day. So first, let's look at it step by step. How do these retail investment apps actually work, right? So the first thing I want to characterize is that there are no massive amounts of barriers to entry when you actually want to opt into these retail investment apps, right? That's because accessibility is their selling point. And when we say accessibility, that means that there's an ease of, they try to lure you in with like the ease of operating. They tell you that you will have like gift certificates or like zero interest loans and things like that, basically luring you into thinking that they're giving away free money, or even having like these marketing ads on social media that are targeted towards yuppies, towards middle income individuals. And a lot of the marketing is essentially based on FOMO, like everybody is doing it, so why not do it yourself as well, right? And ultimately, we think that this is quite predatory and even exploitative because it's coming during a time of low job security, especially since the pandemic continues to ravage a lot of countries, even in the global south. So people want and even need easy ways to make money at the end of the day, right? So ultimately, then it's very exploitative towards the average person on the ground, and they actively feed on ignorance and even on desperation, because it's in their interest, as I'll explain more on later, why to maintain this kind of information asymmetry, right? Where you aren't aware of hidden costs, you aren't aware that they're selling your data actually even to other companies, and it's also unclear to you how they profit because you think you're getting free money at the end of the day. And so when we say the rise, without the rise of these retail investment apps, only a small number of people would be able to access retail investment or even investment as a whole, people in the upper echelons of society. But even if those harms and risks still exist, these people would be able to absorb it better, and the harms would not be as widespread as they would be now that these things are rising, right? So that leads me then to my first constructive about why it would be principally just for us to regret the rise, or why it would be principally unjust for us to even stop that rise, right? So the first level then is that barriers to entry are principally justified because they prevent damages to individuals. And what does that mean? Because ultimately, when you opt into investment, you need to ensure that you are ready to absorb the high risks that come with it, right? Because we need to remember that investments are high risk and high reward. Even if retail investment can be cheap and can have like maybe small starting costs in their best case, you need increasingly higher risks and higher investments to get the higher rewards that you actually want, that you actually entered investment into hoping to get, right? Because we need to recognize that you're not going to generate a lot of income if you only continue investing like a small amount of money. So the benefits of more people being able to access a lot of money aren't even going to accrue. And ultimately, though, you're likely to invest higher and higher amounts as you try and get those high rewards, because that's how this works. It ultimately works almost like a gateway drug at the end of the day. But even if you initially just invest a little amount of money, the reward you get from that will embolden you to spend even more and even more. And that's a very, very great risk, considering that there's a low barrier to entry and practically anybody can just do this, right? So second level then, but why it's harmful to the state, why it's harmful to people on the ground as a whole, harmful even to society as a whole, and why it's justified for us to regret this rise then. Because we say that the state has the authority to disallow you from making certain choices if they will do more harm than good to your person. That's why we have things like smoking bans. That's why even like gambling with actual gambling is heavily regulated, for example. And that's ultimately because the state recognizes that economies, that the world as a whole will become unstable if more and more people continue to opt into retail investment, if this information asymmetry persists. And that information asymmetry is very likely to persist because these companies prey on you. These companies actually actively profit off of that information asymmetry, right? When we say that there's a rise, it implies that massive amounts of people are essentially betting money on these retail investments. And when you invest, it means there's on a macro scale less money in circulation because you're not spending it directly on goods and services. And ultimately, these retail investment apps and companies have an incentive to push for deregulation because, deregulation comes with lower barriers to entry, which is the main selling point of these apps, the main selling point of retail investment as a whole, right? And ultimately, deregulation is still bad for the state because there's a risk of fraud. The state is unable to regulate what exactly these companies are doing. But even on their best case, the state wouldn't have an incentive to regulate too much because there would be capital flight of these companies for a more lucrative market elsewhere. So ultimately, even on their best case, the information asymmetry still persists. More and more people continue to opt into retail investment, even investment as a whole, without being fully aware of the harms and the risks that they're taking upon themselves, right? But third level then, why does this embolden the privileged elite to continue manipulating the market at the end of the day, even if it supposedly democratizes finance? We say that richer investors have a prime mover advantage, where they invest in these kinds of smaller retail apps so that they can control a lot of shares and they get more power to do so. That's why you end up with things like the GameStop scandal, because there's an incentive to short sell, to do similar things to manipulate smaller investors, and they're able to get away with it, again, because of that information asymmetry that continues to persist with the rise of these like smaller retail apps, right? So ultimately, they don't allow middle consumers or like the average person the perfect information or the perfect amount of information to make investments, because you don't realize that even if you just buy one share, you're already operating under these richer investors or even competing with them, and you don't stand the chance at the end of the day. Those are the kinds of risks that you aren't aware of when you opt into these things, right? So on their side, it's more harmful to the state, it's more harmful to individuals. We end up with the same privileged elites dominating the investment market, even in their best case, which means that the goal of retail investment, which is to democratize finance, doesn't even come true. More than that, the state fails their mandate by not imposing regulation or doubling down on financial literacy efforts to stop the rise of these retail investment apps at the end of the day. These harms already exist in status quo. They'll continue happening as the rise continues unchecked, right? So second argument then on a pragmatic level. The first level of that is why the rise of retail investment damages the state's financial literacy efforts, why those financial literacy efforts are even diametrically opposed to the interests of these kinds of people, who would, run these kinds of apps, right? So ultimately, why is it going to damage those financial literacy efforts? There's a competition for information because people have a limited bandwidth of what they can absorb, right? So ultimately, the amount of time that things are published in the media, the amount of ads that are published, the state is actively competing with their information campaign is actively competing against those by Binance, by Robinhood, and by these kinds of apps. Ultimately, the clear harms presented by any financial instrument need to be explained, which is what financial literacy efforts by the state ultimately push for. And I already explained why the average reasonable person gaining more knowledge damages the information asymmetry is against the interests of the owners of these financial literacy apps, right? Retail investments antagonize these because they prey on that information asymmetry. If I know that I need to risk money I don't have to turn a profit, I wouldn't opt into investment in the first place. If I know I'm unlikely to become super rich, if I only invest small amounts of money, I'm unlikely to even use these apps, meaning that these retail investment companies cannot then profit off of me, which is against their interest. Thus, it's in their interest to keep me in the dark. That's diametrically opposed to the state's financial literacy efforts, right? Ultimately, what happens when you don't opt into these financial literacy efforts, or you invest in stocks that aren't lucrative because you're unaware of the volatility of the market, and you don't know that it's not just you competing with other small-time investors. You don't know that you're also competing with like big investors, with supercomputers, with like high-frequency trading bots even, right? It's like gambling because it practically follows the format of gambling. It's framed as a harmless and micro-level thing you can opt into without risk, even if that's not truly the case at the end of the day. But second level then, why information asymmetry is bad for these mid-income investors. The rich are always going to have the upper advantage, right? They have large starting capital, they have hedge funds to minimize risk, they have massive supercomputers, they have those kinds of things, right? And companies are going to get richer because opponents become quote unquote dumber as the information asymmetry persists and is pushed by these companies. You don't realize that you're also a victim of the rat race, and ultimately that leads to you becoming most harmful of all, complacent about inequality in society. You think these things are a perfect solution to widespread poverty and things like that, when actually they're just another band-aid solution. They're just another thing that keeps you in the dark and fools you at the end of the day. Thanks.
I thank the first affirmative speaker for that speech, and I would like to invite the first negative speaker to continue the debate. Here.
Hi, am I audible? Okay, great. I'll take that. That's audible. Okay. Retail investment is not a lottery. It is a collection of factors that exist in financial markets that allow people to earn a profit. I think it's quite disingenuous coming from the previous speaker to just talk about how, retail investment or the ability to invest when you're not given as much information is essentially high risk, high reward. I think for one thing, the framing is very unnuanced to the actual way in which retail investment has risen. Given that this is a retrospective debate, it is important for them to frame what that actually looks like today. But more importantly, I think given that they're not able to take or preempt the fair clash or frame coming from our side, they already lose the debate. 3 points of setup. First, just to clarify, there are low and high risk options. So it is untrue that all investments are high risk. For example, low risk options such as low volatility stocks, right? Like you could also only invest in the biggest and safest companies in US stock markets such as Apple, Google, etc. Right? So individuals can just hold their investments for a really long time to lessen the risk, or stake their investment in which their share of the company is guaranteed to increase. So even if the stock devalues, they will be able to eventually get a return of investment, right? But this also looks like high risk options such as day trading that are much less accessible, and typically only to those who are more educated anyway and are capable of investing in them. More on that later. But also, just to clarify, retail investors have the option to control the amount of board lots of stocks they purchase. So it's not like a lottery where you have to give a specific amount, right? You can kind of calibrate it to your ability. Second point of setup, what does the rise look like? First, this looks like platforms that wanted to cater to the rise of demand from the middle class to earn more money. So the way they did this was by making these platforms easier to access, right? Lowering amount of money you need to invest, lowering fees and interest rates. Second, where the rise has looked is that companies also funded and pushed for information campaigns, especially for increasing financial literacy, because companies have an incentive to make sure that their customers turn a profit to improve their brand image and also to improve or to increase the amount of people who invest, right? But this also looks like the development of apps like Instagram that allow you to practice trading without real risk and provide online courses about financial markets because the demand for that has increased. This looks like state regulation that still exists and is sufficient. And even with less regulation, corporations are actually held more to account because they manage a lot more accounts and they have a lot more investors that they have to appeal to. I think the strategic importance is simple. Retail investment still has to exist on affirmative side, but on their side, only the rich can succeed or access this. And I think certain middle class and poor people would still do it on their side, but without the rise, it's much more dangerous and they're likely to fail. Last point of setup then, who invests in this to begin with? It's typically the vast majority of middle class individuals in status quo or with the rise. So it is untrue that people who invest here are super desperate and I think it's not true that they're using this as a last-ditch attempt to get rich or die trying. But this is also things to clarify, like the financial literacy point in the rise proves this, right? That people know that investments are long-term endeavors and many will wait for years for the return of investment. So people who partake in it anyway are those with some level of disposable income. And of course, they only invest in what they are already ready to lose. So first argument then, all responses are going to be integrated. How it led to an increase of financial literacy. Why did corporations and platforms, right, such as Robinhood, have the incentive to increase financial literacy? Two things. One, that they directly benefit from you making a profit, right? So this directly disproves AF's claim that these corporations benefit from you losing money, right? Because first of all, they get taxes from all your profits and investments. So when this is a lot of people that continuously invest, that's a lot of money. But secondly, they need to encourage continuous investment from their consumer base, right? So the middle class's lack of financial literacy makes them risk averse to investment in general. So they saw like stocks as abstract and amorphous and akin to gambling before the rise. This stigma makes it such that the middle class people will need immediate success in their investments for them to reverse the stigma. And I think that's also why there's just a general rise in making financial literacy more accessible. But lastly, that more people investing in a corporation means more money for them to operate and generate greater profit, right? So rich people would have invested either way. So the general public are the new margins that corporations have the most threshold to increase revenue from and are more likely to try to cater to as well. So I think the second level of this is otherwise there will be backlash and losses of competition and general revenue. If people lose money and feel misinformed, they're likely to do things like go to another platform or no longer invest in your company, which is what corporations do not want. Hence why there is a general demand to give people financial literacy, right? But less people investing is just less money you can charge the transaction fees or less revenue that can be reinvested for corporations. So increased demand for financial literacy, which the market naturally adjusts to, is also the reason why there's just general growth of financial literacy, right? So again, the development of apps like Instagram allow you to take courses or practice without real risk. But why is this increase for financial literacy good? So first, it spills over to other things, right? It motivates people to learn, to generally be more invested in the corporate world, meaning that you have people who are more likely to follow corporations, their actions, and hold them accountable. But this also looks like helping people with the management of funds. That retail investment, like cultivates risk calculation in people who subscribe to it, which means that you're able to apply these skills that you learn into other aspects of your life, relationships, works, etc. But more importantly, that this information is spilling over to to other individuals, poor individuals. So Instagram is not only focusing on retail investment, but has expanded to teaching people about debt management, how banks work, etc. Importance of this argument is simple. This argument proves that even the sheer rise is beneficial, regardless of whether or not people actually opt into retail investment because of the trickle down of information. Second argument, greater financial independence for the middle class. Why will retail investment succeed? So obviously the middle class care about their money and they're likely to spend it wisely and constantly monitor it because they do have something to lose and they care about it. And given this, what are the nuances to retail investment that make it better for the middle class? So first is retail as an industry is guaranteed to have constant demand. So its products have tangible value. It's comparatively easy to understand each company's unique selling point. So the biggest companies usually provide basic necessities with inelastic demand, and luxury product companies are a lot more high risk, high reward that can be transitioned to once they've built a certain amount of capital. But that also all people really need to do to earn money is to listen to some tips and opportunities from Robinhood, and I think read up on it, and that will teach them what months are good times to buy lows, such as September, and what graph indicators suggest that it's time to sell, right? So it's not time consuming compared to working or starting a company. This is a form of passive income you can earn on the side while still cultivating your career. So why does this significantly benefit the middle class? Because just to clarify, what was the state of the middle class before the rise of retail investment? I think it's very simple. The vast majority of them would not have been able to access these types of things, and they only have to focus on their 9 to 5 job. Right. This also looks like things like COVID, where they have a lot less job security, but this is something that they can do regardless of whether or not they get hired for a job. So why is this then better than the alternative that will likely exist on government side? The desire to become rich as a middle class individual is a constant, even on affirmative, right? People toil their 9 to 5 jobs. They want to retire as soon as possible. Capitalist advertising makes them want to buy luxury products and tie consumerism to happiness. So for a vast majority of people, this is what they ascribe their social value to. They would rather focus on finance, and I think that's pretty much why people, it's just better on our side because people are able to try to pursue that. All this proves is that people will still try to get rich on affirmative, but with much harmful alternatives, right? Like starting their own side businesses that take a lot more time, like people investing in cryptocurrency that has risen independently from retail investment, or things like people just wasting their money on the lottery, even if there are worse chances for success. I think overall, all of the harms affirmative says still apply to their side. It's far worse because there's less education and less infrastructure. You must side with us where we support the rise.
I thank the first negative speaker for that speech, and I would like to invite the second affirmative speaker to continue the debate. Here.
Hello, just confirming if I'm audible.
Yes, you are.
All right, I'll just drink a bit of water. Starting my speech in 3, 2, 1. Just because a treasury bond is labeled as moderately conservative does not mean there are no risks there. I mean, for such investments, right, you still need thousands of dollars in order for you to rake in some kind of profit. But if OP does not want you to rake in that amount of profit, then what is your benefit? Why do you need to invest in these things? And why not just deposit them in traditional banks, for example, or produce or buy goods and services that will rake you in that kind of capital at the end of the day? I'm unclear what the unique advantage is of you pursuing retail investment as opposed to working a day job, for example, as opposed to pursuing that particular business, as opposed to, I don't know, getting informed. 2 discussions, 1 on bad corporate practices and 2 on bad economic outcomes on the macro level. But before this, I want to address this setup coming from Leader of Opposition in terms of rise. So the points of framing here is, firstly, we argued that, the rise is because of massive subscription bases in order for these applications or softwares to become profitable, like Binance or Robinhood, for example. Second, we do agree that, you lower these fees from these applications. But if you have lower fees to enter, how do they fund their business? Probably there are hidden costs that you are not aware are not aware of because you did not read the terms and conditions, for example. Probably it's data mining and things like that, which we've argued already are very pernicious in terms of you as a consumer and why that is bad in terms of market manipulation. Third, they argued about information campaigns, right? Because they want people to have profits. I'm unsure why this is true, why these companies want to rake in profits for their consumers. I'm pretty sure all of their profits rely on this subscription base. So if they have a lot of people entering Binance and getting that $500 gift checks, for example, I'm pretty sure that already funds a lot of their business. But second, I'm unsure what the quality of that information is. So sure, Binance teaches you how to invest, but what about the trends? What kinds of investments are you gonna rake in? I'm pretty sure that because of the information asymmetry that Sophie argued as to why it's detrimental for middle income consumers, then this harm still exists. People will still have the prime mover advantage over you. But I'm unsure why this is already a benefit, given that they're already in that risky business of investment, as opposed to our world when they're just learning about this kind of information before they decide to invest or not. So, like aside from this, they argued a couple of things under information. A, that these people need profit and continuous investments from their consumer base. But LO also says, right, that middle class people are averse to investment. So then why will Binance tell you that it's risky to pursue investments, that your 10 USD won't really turn to 15 USD after 2 years, when they can just give you a gift check and not inform you about the possible repercussions of investing in low lucrative like treasury bonds, for example? I'm unclear what kind of information they're going to put out on their side. But second, they argued about backlash. One, these companies will always have the defense of legality. Again, it's already in the fine print of the terms and conditions. They have no obligation to tell you if you're going to be rich in the next year, for example. But two, again, there are external costs to this, like always competing with a richer investor, because they have enough starting capital, for example, to pursue and buy most of your shares and manipulate you into what kinds of investments you're gonna put out. Conversely, on the third level, I think that they never responded as to why there are reasons why this is an antagonistic effect to information campaigns of the state, right? For example, retail investors are likely to downplay the risks of certain investments, precisely labeling them as moderately conservative because they want people to opt in order for them to rake in that capital. But second, I think that states comparatively on our side need to explain that investments carry a lot of risk, regardless of your risk profile. For example, investing in a bond is essentially you taking out a loan and it might deteriorate over long periods of time. I think that a world wherein Investagram is state-run is far more preferable. And a world without the rise is one wherein the state's information campaigns are able to deter you from making very risky and very rash investments. And it's okay until you are able to like rake in or absorb the costs of that. Then they say, financial independence. One, the market is very volatile. Literally, there are like a lot of fluctuations in like tech feeder mutual funds, for example, because of COVID-19. Two, LO says that people know that the ROI is long-term. So what kind of income will you gain in the interim period in order for you to pursue these kinds of investments? I'm unclear how this gives you financial independence to the extent that you have not raked in that ROI. Third, there will still be information asymmetry on competing investors, which means that the rich will also know what stocks to buy, so you don't get the lucrative stocks anymore, but then they will also get to tell you that, buy this one, in order for them to have those pernicious incentives to manipulate the market. So in conclusion, I'm unclear what kind of information they provide inside opposition. At least on our side, it's preemptive. First, discussion on bad corporate practices, 2 levels under this. Letter A, these corporations will always have perverse incentives while cosplaying as attractive and affordable because of the low entrance fee. So they need to have profit margins as well, which hides the pernicious practices of these applications or corporations. One, they're likely to sell your data to big corporations, which you cannot consent to because terms and agreements mean nothing over a free $500 loan on that side of the debate. So if your data is sold, your tastes get manipulated, you're raked into this very addictive gambling circumstance of you consuming without knowing what the hell is going on. But two, shady transfers of money, for like instance in these Binance and other applications also exist more, like brokerage fees, for example, of Robinhood to, I don't know, JP Morgan was unfounded in 2020. No one knew where this money came from. It's probably through like a lot of like consultation fees, for example, which is very bad in terms of manipulating what stocks are deemed lucrative by the rest of society, and also sets a precedent for being complacent with antitrust policies on that debate. But on the comparative on our side, without this, I think there's massive crackdown in investments. Okay, this is inaccessible. Okay, your econ growth is low. At least information is not antagonized, and it is better because the state's commercials do not have to compete specifically with these ads of Binance telling you that it's very easy for you to earn $1,000. Second level on why these apps manipulate the market in very pernicious ways. These applications work in two different ways. One, they let you invest on your own, which we've argued is already bad because of information politics. But two, they let their own algorithms predict which ones are deemed lucrative. Like, for example, in the Sun Life app, which I also have investments in, by the way. Why is this harmful? They dictate how your investments run, especially because risk profiles are subjective per app as well. There's no objective standard as to what is risky and what is moderately conservative on that debate, which makes it easier for them on large corporations to collude and strategize to buy off these small like applications and tell them that you need to tell to people to buy our stocks in order for us to gain massive amounts of profit without informing our consumers. And we think this is bad. This increases the volatility of the market and also removes information from people in general. So I'm unclear why these large corporations get to be big and these SMEs get to be poor. Comparatively, market manipulation on our side is way less because states are able to regulate you or at least hedge consumers against these risks, ensuring that people are most informed on our side of the debate. So in conclusion, right, it's still bad on their side because of these hidden practices that they have to concede to in order for them to win the debate of their own frame, that these applications have lower entrance fees. They have to discuss why these are not costs. Next discussion of bad economic outcomes. Letter A, traditional banks lose their power, right? Now there's no demand for traditional loans and most money is stuck in financial investments anyway, which makes it far more unlikely for middle income people to access their money and like deposit their money and gain loans when they need it to be. We think that this is imperfect on our side, but we think it is necessary for funds to stay in banks to fund and invest in commercial goods and services. This is precisely why in Haiti or in Zimbabwe, almost all SMEs defaulted due to a lack in minimum reserve. On their side, because of this rise specifically, massive amounts of income of people are directed to these apps instead of banks, which provide livelihoods for people. Second level, it deters people from working. And this is the best case of opposition wherein people are satisfied and happy. 3 points of framing. A, retail investments are easy to access. B, retail investments go alongside gamified crypto and digital systems like Axie Infinity. C, there's a massive anti-work movement from middle to upper middle class people because of financial crisis and bad education. We think that this is terrible because you lower productivity in economies. For people left in traditional jobs, you lower their working conditions, for example, and in general, it's untransferable skills. In conclusion, we've defended a world wherein their own best case is also something that's bad because you destroy the economies in these instances only specific to the rise. We would rather have a world without Binance and without Investopedia if it means people are more careful and they don't gamble away their souls.
I thank the second affirmative speaker for that speech, and I would like to invite the second negative speaker to continue the debate. Here.
Hello, am I audible and visible?
Yep.
All right. Let me set up my timer. Okay. Starting my speech in 3, 2, 1. Affirmative tries to win this debate by harping on the problem status quo, that certain industries are risky, but they never provide a comparative as to why their world is better. Because we told you strategically from first negative, the urge for individuals to get rich and social climb is always constant because of how capitalism works and markets these luxury products to people, because of how the middle class ascribes most of their social value to the amount of money they can earn. So therefore, it's not a debate about where there is risk or there's not risk. It's where we satiate that in the safest way possible. And therefore, affirmative cannot win this debate with their counterfactual, because realize that Binance and cryptocurrency is the counterfactual on their side. And this was in protected time, by the way, of the previous speaker, right? So I can prove that cryptocurrency and all of these other risky, volatile things is worse without retail investment industry than they lose on the spot. Before I go to my arguments and comparatives, two responses on like two alternatives. Firstly, they say that banks are better. If they really go for long-term profit, then why not they just invest in a bank necessarily? We tell you that there's still an inherent difference between banks and investment in companies, right? Because banks and their interest rates are so low because the relationship there is completely predatory because of the fact that, you know, you're giving them their hard-earned cash, and, you know, people usually like view it as a storage vault for money. Honestly, like there is no competition or reason for them to provide high investment rates. If anything, we tell you that investments actually have a chance, even though it's still long-term, obviously, compared to bank interest rates, which are like 0.5%, 2.5%, investments can still give you as much as 12% or like 10% like annually, which is still not enough to retire, obviously, after 1 year, but it's so much better. Why? Because it's tied to corporate success, the capitalist machine, which they demonize so much. Now we give middle-class people a chance to benefit from the industry that preys off of them to begin with, and therefore empowers them in that way. In anything, we're not killing banks, and that extension is not correct, because banks still have a way to survive. They simply need to become more competitive. They simply have to invest equally better and use people's money and provide competitive rates to them. So like that's why we see the trend in the Philippines where BPI, ING, and GCash are now providing like opportunities for investment, safe investment, and also higher interest rates. We think we win that clash convincingly. Okay, let's actually break down why it's not actually that bad. Firstly, we already gave you mitigation that these are middle-class individuals, people who invest what they are ready to lose. At the very end of the day, since they conceded that these are people who know that they're doing a long-term investment and things like that, and these aren't people who will trying to get rich or die trying. They won't like blow all of their money and die just because their first investment fails. So at worst, they invest what they're ready to lose, and that's not even that bad at the end of the day. But more importantly, if we're going to talk about how Robinhood wants to profit, and this is where we engage in all of their scams and their gift cards, etc., they didn't engage on how we told you what their profit model was, because it's not a gambling site. If you put your money in there and you lose it, it doesn't go to them. It goes to a random person who sold the stock, which depreciated, right? So for these companies to actually profit, again, as we told you, they need to get the tax rates and the small like interest rates that they get when every time you make a transaction, and therefore their earning is contingent on your continual investment there. And since the middle class is so averse to losing, they need to make it so that the middle class can actually win, not just with like like the initial $500 certificate. It's actually like a long-term investment thing if they want them to stay on the website and those kinds of things. So therefore, this is why they're really incentivized to teach these people how to trade properly and stay on the platform. They said in second affirmative, oh no, but okay, they'll teach you some stuff, but no, what about the different trends? What about the different investments, different companies? Yes, they give free education on all of these things because it's directly proportional to their profit. Binance really talks to you about different coins. It really tells you about every single indicator that's on there. I mean, like Robinhood does this as well. I'll tell you why the comparative of Binance is also worse, right? So yeah, that's why education is genuine. But more importantly, even if the rich want to manipulate the poor, this is where we respond to first affirmative and it's so bad for this information asymmetry. Three levels of mitigation. Firstly, again, the fact that the state really has a heavy incentive to regulate this industry. The fact that we conceded that there's less regulation because it's lucrative doesn't mean that there's no regulation. We say that the regulation is still sufficient. Investment companies need to provide their information on their backing and their value. If it becomes a massive economic effect on a macro level, like they said, then obviously the state can use this to justify the regulation of its industry. Most importantly, it's linked directly to the retail industry, which has a tangible value and is not like cryptocurrency, which the state cares about, and they will weigh in if they need to. But more importantly, like it's if they're cracking down on cryptocurrency, which has no backing, look at how bad it is, right? In the very worst case, the US and China are already cracking down. Like US's force gave Tether an ultimatum to reveal their financial backing, or they'll have to take severe action. But more importantly, even if the state is completely out of this, we ask, how do stocks really work and how do you get value from it? Because we told you from first affirmative, it's these companies which are too big to fail that you're investing in. Retail is super safe. It's either Apple or Amazon or Target or Walmart. Why is this risky? Why is it going to fluctuate so much? But more importantly, like if there is something that's going to shake up these massive companies in a big way, then clearly the free education that Robinhood can give you on these subjects is going to be sufficient at the end of the day. But okay, let's say that this is, pretend for a minute that it's as volatile as Wall Street and stock exchange and stuff like that, right? We tell you, when does this, how do rich people make money off of this anyways? For them to pump and dump, they clearly need to pump these stocks to begin with, right? So if ever the rich want to profit, then the value needs to go up for everyone, and everyone can capitalize on that. And when they're educated enough to read the graphs as to when it's going to top, then the middle class individuals can also benefit and sell accordingly necessarily. In the very worst case, though, if anything, if we increase demand for these stocks, which are ultimately mostly driven by public trust and demand, then therefore, objectively, the rise is a good thing because more people will give it value, and then the stock prices will go up so that people can get some level of returns at the very end of the day. And if they treat it right, everyone can benefit, right? So, but now we deal with the comparative, right? The alternatives are so much worse, and they completely ignored the last minute of first negative speech because we told you retail investment firstly always exists, and the nuance of the motion is the rise of this. So therefore, the retail investment on their world is only accessible. There's no financial education, etc. And therefore, that's where they have higher interest rates, right? They have higher taxes and fees of the companies because that's the only way for companies to get the return of investment without a great demand. It's like a luxury industry. More importantly, poor suckers who still want to get rich, who are middle class and poor on their side, will still go into this with false hope, but then there's no infrastructure to support them. More importantly, the other alternatives, right? Cryptocurrency, which again is its own thing. The blockchain technology is separate from retail investing, and it would have existed uncontested without the accessibility of retail value. Cryptocurrency has no actual value, unlike the retail industry, and therefore, if that's all that people had, like the chance to invest in, and Binance still did all their manipulative stuff, then it's far worse on your side. At least now they're forced to both be reasonable. Robinhood has to compete with Binance. The whole industries have to clash, and therefore they have to make it as good as possible. But more importantly, the gambling, the making their own business, the loan sharks, all of these kinds of things are the alternatives that existed on Affirmative before the rise of the investment industry, which is just an app that at least doesn't take much of your time and allows you to still retain your current job in. Everything is far, far worse if you look at the affirmative comparative, and it ties back to their inability to engage on the one simple characterization of the middle class. They always have some excessive, income that they want to invest, get rich on. It's a comparative of where they're actually safer and where they can actually do some safe kinds of investing, because on affirmative, they would have done something much more destructive, much riskier. It's far too late to build that from third affirmative. Thanks.
I thank the second negative speaker for that speech, and I would like to invite the third affirmative speaker to continue the debate. Here.
Hello, just give me a sec. Hello, am I audible and am I visible?
Yes, you are.
Okay, thanks. Starting my speech in 3, 2, 1. Panel, apps like Robinhood that promise the middle-income Joe to enter the world of the rich and the elites to investing in stocks don't really welcome him so he could feast on the table of the wealthy, but rather so he becomes the meal that the wealthy may dine on. Notice that these apps thrive on the ignorance of the public. The more a person does not know about the intimidating world of stock market, the likelier they will feel like Robinhood is an absolute necessity, and the only way they will thrive is to give their money to this app. Fine, we agree that perhaps an average reasonable person is rational and is capable of making wise decisions, but if you subject that same person to the realistic context that we present you, the job insecurity of the pandemic, the lack of systemic access to information, which is prerequisite in managing their stock investments properly, or the pernicious marketing tactics that Robinhood and similar apps employ, these make them unable to resist the advertising seduction with the promise of getting rich quickly. What is the best case of side negative? Why is the best case of side negative still terrible for world economies? One, it will lower productivity in economies which they'd never engage on. Two, for the people left in traditional jobs, I think the lower working conditions more likely to be oppressed into unfair working conditions and extended working hours by virtue of like less clamor towards these kinds of networks. And C, in general, these are non-transferable skills, and this allows people to develop themselves, and this allows states to develop key industries as well. DLO is lying when he said that we did not engage on our counterfactual when we have done so since first affirmative, right? We told you from the get-go that at least on on our side, these kinds of channels will not be available, then we will mitigate the risk to a significant extent. DLO says that banks are less lucrative, but for the consumer, probably just symmetric, not gonna profit your ROI in the short term. They said 12% is better than 0.2%, but this is precisely why you will still give like most of your savings to investments, and it will drain your portfolio. Negative is confused on their profit model, right? I'm unclear why Binance needs to get you more profits because this model assumes that they have high ROI and high capital to begin with. But wait, didn't DLO say that this is just middle income? That's its money, like they're willing to lose. It's far more efficient for Binance to prioritize quantity of its retail investors to ensure that someone gets the baseline ROI and investment over prioritizing quality. Imagine how expensive that is. 1, super low entrance fee. 2, super uninformed people. And 3, compete with everyone. And now you want my company to be the manager of some random person. So clearly, I think that side negative is very confused. 2 issues for you in this debate. Firstly, which paradigm is better for the average individual? But 2, which paradigm is better for the state as a whole? On the first issue then, which paradigm is better for the average individual? They said that, oh, there are low risk options, and realistically, more people will opt into the low risk options. I have 3 levels of responses. Firstly, these are still risks. So at the point at which LO homogenizes this as guarantees, or as at the point at which they say it as it's guaranteed win, illustrates the pervasive marketing of these apps, utilizing the advertisement outlets to reduce the people's perceptions of these risks and make them unable to absorb them when the time comes that they need to absorb these risks. Secondly, they say it's low reward, which means that the help it gives to regular individuals are not as extensive. So I'm unsure as to why people cannot earn that money elsewhere, i.e. depositing their money to the bank, so it naturally gains interest over time, even if it's just a 2.5 interest compared to 12% interest like that DLO says. At least like it's a sure amount, like a sure way to gain money. And I think that when DLO says that it's better than the bank, this is when they fall into the trap, right? They said that in order for the banks to adapt, banks just have to take higher risk so they can have better profit margins via interest. This shows that the rise of apps that encourage betting and hedging on stock market also modifies the behaviors of the bank to the point that they put like more risky behavior so that people can be enticed to it. The impact is there's already little safety nets to have surefire way to gain money, because then you modify banks to adapt into high risk platforms or high risk formats. The third response is that they said that like low risk options are the least attractive. So I'm unsure as to why people will gravitate towards these when you yourself said that necessarily of low risk options are. And much more crucially, LO fails to engage with Sophie's clear characterization that even if the capital is low and the reward is low, this serves as a great gateway to rich quick. That's the point of the app. So people will generally maneuver towards that kind of thinking. The second thing that they said is that Robinhood apps encourages the people to increase the financial security. Firstly, this is a lie, right? Because the selling point of Robinhood is for people to be people need to be dependent towards it. That's why they gain money. So I'm unsure as to why, if Robinhood makes people self-sufficient, why would they still need Robinhood in the first place? So I'm unsure as to what the benefit was on their side. We think, right, that Robinhood has the capacity to massage the market, use the bets of the people to artificially increase or decrease the demand of the market, and have the ability to hedge risks. So I'm unsure as to why Robinhood would be significantly impacted to the extent, right? Also, they never really painted to you what kind of education Robinhood gives to these people, and it's too late if it will come from Upwith. There's no justification as to how, for example, trading in Robinhood makes me better at budgeting our household budget, or how that inherently makes me financially literate. There's no characterization and walkthrough as to how that happens. But even in their best case, when it makes them financially literate, I am unsure as to how Robinhood is necessarily the best actor to teach people about how to manage their money. Notice that the quality of financial literacy education in Robinhood is low because it's focused on hedging and betting. That's the point of the app, and not on more important skills in managing real life finances, such as assessing how to funnel your money elsewhere, etc., and how to also use your money and spend it in a way that it can earn more money, etc. So on our side, we have other alternatives like in earning money or financial literacy. We have education forums, we have podcasts, etc. We have transmission between people, and these kinds of knowledge transmissions are inherently better than what you gain in Robinhood. The next thing that they said is that middle income people will still want to get rich on negative, on affirmative. So it's better on their side when the ability to get rich is more accessible. Firstly, they never really painted the likelihood of a middle income person getting rich when they invest stocks via Robinhood. I don't think the significant benefit is accrued on their side either. But secondly, so at the point at which they don't get rich on negative, and this is a majority of them because in stocks, more people lose and less people win, and with information asymmetry brought by trading against dedicated supercomputers, the losers are usually the middle income people. So when the middle income people don't get rich, they still probably will opt into harmful options that negative builds, like cryptocurrency that doesn't get real value, or perhaps loan sharks. So the harm is symmetric. But I clinch this victory by saying that Robinhood enables this behavior and fuels these kinds of tendencies, because when you don't have any more money to to invest, you're more likely to opt into these kinds of endeavors, or perhaps the betting nature of like these apps like also are transmissible to like gambling or like loan sharks or cryptocurrency, etc. But fine, even if they get rich on their side, these are just like isolated cases. I think that even if Robinhood has the necessary, has the interest to propagate a narrative that some people will win, like these are just like isolated cases, and Robinhood has the advertising machinery and the resources to bury narratives of failure and advertise narrative that some people get rich because they let Robinhood autopilot their money. Second issue then is which paradigm is better for the state as a whole. LO says that retail investment companies will want to participate in information campaigns because they want people to know about them and opt into their services. LO says that they have an incentive to opt into regulations by the state because of the course that they need to operate legally, and of course they don't want to be affected by backlash. Well, yes, these companies do want to avoid backlash, recognize that the opting into regulations are likely to be tokenistic, just like every corporation that operates legally but still engages in abusive or manipulative practices in reality. And other information campaigns are still likely to give you incomplete information. Pop-up ads that make you think you'll earn free money are technically legal because the app still shows you the terms and conditions. Never mind that nobody bothers to read these terms and conditions, and very few people understand the implications. There was no engagement from DLO with Raffy's extension about how their paradigm endangers traditional banks and endangers MSMEs and traditional economy as a whole. Instead, DLO didn't engage with the fact that the skills you learn from retail investment are non-transferable, and even more dangerously for their case, hand waves Raffy's extension by simply saying that banks need to take more risk if they want to survive. It's very negative loses this debate because the moment they fail to engage with their worst case, when the average consumer loses so much money and taking risks they don't have the capacity to take, and also fails to engage with our very clear characterization of a realistic best case, where the average person earns very little from retail investment after investing very cautiously in only small amounts because they don't want to take risks, knowing how cutthroat the financial market is. Thanks.
I thank the third affirmative speaker for that speech, and I would like to invite the third negative speaker to continue the debate. Here.
Am I audible?
Yes, you are.
Okay, I'll take. Oh yeah, hope you are. Sorry, forgot. Okay, just setting up my time. Three clashes in this debate. Firstly, on regulation, secondly, on information, and thirdly, on will it actually benefit the people and the comparative that exists on the government side. But before that, a couple of extraneous things. The first thing I want to do is clarify the comparative. Just to be clear, they can only regret the rise of it and not the industry itself. What that means is that this industry still exists, but far worse, far more exploitative, because all the reasons we gave to you to make information accessible, to increase corporate accountability because you manage more accounts, doesn't exist. What is the harm here? There are still some middle-class people on their side who access these platforms and are harmed to a far greater extent. So they can't just get away with saying, at least less people are exposed to it. There's still a reasonable amount of people that they leave and abandon. They had to prove as to why they fix these problems. At no point in the debate did they prove so. The second thing I want to deal with is just this first speaker argument on like state paternalism, like the state has to protect you against information, etc. Just to be clear, this is a regrets motion. It's not a ban motion. I'm not particularly sure as to why this is relevant. The state is unlikely to intervene. The second thing, I want to deal then with the extensions of the previous speaker. Of the second speaker. The first on banks. I'm genuinely really uncertain with how this mechanism works because banks are private. People will still go to banks because that's where their money is. I'm not particularly sure as to why it will harm banks. Moreover, banks have a shit ton of money. Even if it harms them, I think they'll be fine. It won't harm them to a significant extent because generally you do need banks to have financial systems. I'm not particularly sure as to why this ought to be important or why this is even true in the first place. The clear extension from second speaker was on market manipulation. Verbatim, corporations will come up to you as a platform and buy or bribe you to make you like sell their company out to more users. The first thing I just want to note is, again, no comparative to this, but the second thing is that actually do fix it, right? Because if these platforms earn more money because more people are part, there's more transactions, they don't really have to rely to these sketchy bribes or these corporations anymore, and therefore there's a lot more like less corporate manipulation on our side. I just want to deal with the responses to financial independence before I move further because they're very dismissive. The only thing we hear is that ROI takes a long time. It's tied to crypto and there's a rise of an anti-work movement. Firstly, ROI does take a long time, but it happens periodically. And I'm actually going to use their analysis of the market being volatile against them. Because if it's volatile, then there are peaks where people can actually gain money at a larger, quicker amount of time. And when there are like obviously downfalls where you have to take a longer period of time, what that proves is that there's, because of the fact that it's volatile, there's still people that can earn either periodically or can earn at a faster period of time to the point where it's still substantial. The second thing on being tied to crypto, I think Riv dealt with it sufficiently. Like obviously the vast majority of people who use Robinhood don't really invest into crypto. But the third thing is the anti-work movement. And this is important because I think the reason as to why the anti-work movement had so much power and people were, for example, willing to convince corporations to demand you being allowed to work at home is because people had contingency plans. Our side gave people a way to make passive income without going to a job. What that means is that people were more willing to support the anti-work movement because they had programs like what we defend under our side to make it that they can still get income even if they actively go against their employees. They have that contingency plan. So I think on that note, we probably strengthened the anti-work movement. On regulation, what did they say? The first thing that they tried to say is accessibility means that there's are little to no barriers to entry. Firstly, this is not true. We can test it at all speakers. There's some form of regulation, and moreover, there's an incentive to have regulation, both from the state because you want to regulate people, like what first affirmative said, but also as corporations because you don't want everyone to go broke. Because how then are you going to make money? The second thing is I just want to question. What is the harm of the lack of regulation? And at actually no point did they illustrate why it was so damning. I just want to characterize that the people who these ads targeted are not the poor or the most desperate people. Like these are the middle class people who have some sense of like disposable income or disposable income. So I think on that note, even if there's somewhat a bit of a lack of regulation, these people still have a safety plan to fall back on. The harm isn't that immense to them. But the second thing, and like we contested at first, not all investments are as high risk and high reward as you think. There's a spectrum of corporations and stocks you can choose to invest in. Moreover, and this is important, if you're new to the app, realistically, you won't just invest a huge sum of money. You'll probably invest small amounts of money until you get the hang of it and until you have enough experience and information. Only then will you be able to take those high investments. So I'm not particularly sure as why the lack of regulation is that damning. The next thing that they try to give extraneously is data mining and collecting. Firstly, I'm unsure of how this looks like. Like they get your preferences and suggest you a company you might like, but that's still false because the vast majority of people consider the risk and the company's success rates and the trend that they're likely to have in the next quarter. So even if they data mine, I don't think it will lead to worse decisions. But the second is that they don't own your data. Like this is just not true. They don't own your data, so they can't sell it to other companies, and they receive heavy backlash if we do, like we see with Cambridge Analytica. I'm not particularly sure as to why this is one inherent or secondly true. We weigh that against what we said, right? Where regulation right now is sufficient, but moreover, we have an increased amount of accountability because the platform itself has to manage a lot more accounts. We gave us all the way from first speaker. The only response we hear in terms of backlash is backlash won't work because they have a legal advantage. But that doesn't matter. It's about public opinion. If people think your app is exploitative, if people don't trust you as a platform, they won't invest in you. So the public image is important in order to get consumers. So even if legally you have the advantage, you still have to care about your reputation. The second clash then is on information. What did they say? Firstly, rich people buy stocks and manipulate or trick poor consumers. I'm unsure how this process happens because, like, realistically, you don't contact a rich person for what you should invest in. In fact, you would probably invest in a very safe company first that has a good track record and is on like an upward progression. So I'm not particularly sure as to why this is even likely to happen in the first place. The second is that just dealing with short selling because they seem to rely on it a lot. That will never happen again, nor is it actually inherent to retail investment. Moreover, this was the reason as to why short selling was so bad was because of a lack of financial literacy, which we provide to the most vulnerable. Short selling will exist on their side. When it happens again, it is far worse for the people. The second argument they give is on information asymmetry. Firstly, this isn't significant. People want to know where they are putting their money in. What that means is that people are naturally speculative of the process, especially when it's just newly introduced to them. They either have enough information to make a reasonable decision or they just do not invest. So there's an incentive for you to either get information. If you don't get that, you won't invest, which is obviously against corporate interest. But the second thing is that they give, again, no comparative to fix it. We prove the comparative incentive to do so, like how corporations benefit from you making decisions. It's directly proportional to the revenue, or they don't want to lose to competition or want you to go to another app, all of which you're unresponded to. The third thing that they try to say is, and this is important, it takes time away from the state to educate on financial literacy. One, at no point have they illustrated what this looks like or why it is successful. This has proven time and time again to be unsuccessful because there's a vast majority of people who don't opt into it or find it way too abstract. But secondly, we're talking about the middle class here, so they already have some sense of literacy. I'm not particularly sure as to why they need the state's help in that regard. We told you financial literacy. There are incentives to do this. It spills over to other parts of your life, such as ad revenue and taxes on transactions, etc. Their responses. Firstly, it is based on a subscription model. This is dismissive. Obviously, if you lose money and can no longer use the platform, the company loses a consumer, therefore they still have to care. But secondly, literacy doesn't bleed to other areas, and they never give a reason why. I think that, for example, if you invest in something, it helps with how you manage your funds at home, because you now realize how much you need to save in order for you to invest, for example, in a specific company. So I'm not particularly sure as to why it doesn't help. And the only thing we got from a third affirmative, which is an illustration, no actual reason. But the third thing that they try to say is that Robinhood doesn't give good programs. We work in conjunction with other programs like Investograms. But moreover, even if Robinhood doesn't give other programs, the rise that there are more companies doing it, so they can counter Robinhood's narrative, give a lot more information on net, which still leads to people having a lot more informed decisions. At the end, even if you don't buy all of my sponsors, the wink here is crucial. Can people make informed decisions? The only thing they try to say is no without any reason why. I proved to you as to there's substantial risk when you opt into these platforms. What that means is that people won't just be enticed by that gift card, they actually care about where their money goes. And lastly, on the comparative, we told you the harmful narrative is that either predatory loans, you get co-opted into, for example, doing startups you can't manage. There's been no response as to why this is the case. We've proven as to why it will exist because it's an incentive for the middle class to get as much money as possible, and that continues to exist even without regretting the rise. For all those reasons, vote for negative.
I thank the third negative speaker for that speech, and I would like to invite the negative reply speaker here.
Hello, am I audible?
Yes, you are.
All right. Starting my speech in 3, 2, 1. To be honest, it's hard to structure this, so I'll just clear up like 7 problems with the debate, so it's simple to adjudicate. Firstly, when they have this weird clash on our model about whether it's get rich fast or if it's really low risk investments and a long-term kind of thing, notice the contradiction in affirmative, because we were very clear from negative, in which we said, yes, they can choose low risk options. They'll only invest money they're willing to lose. The weird thing about AF is that sometimes they force us to defend that they really are trying to get rich fast. But more importantly, at other times, their speakers concede that, okay, maybe some people know that it's low risk and only invest money they're willing to use, and they try to use that to water down our benefits. But the reality is we never hinged our win on the benefits being so big. We conceded it's long-term from the beginning. Yeah, it's passive income, it's side income. So in the very worst case, sure, they don't, best case of us, they don't gain that much. But in the very worst case of us, all of their their harms are watered down, which is that if people do get scammed, it's not much to lose. It's not going to end their lives. And since we still prove that there's a chance and it's likely they'll gain something, we win on impacts. Next issue, back to the traditional economy. They say that we forced them to take more risks and sell out the crypto. We never said that. My response to this was to say we just need to give more concessions to their customers, give them more competitive interest rates and opportunities to invest in a safe way. No response to that nuanced response. Next, about the retail industry. They tell us that we're trying to destroy the traditional economy. When in reality, we told you from the beginning, the retail industry is the lifeblood of most of these economies. Companies such as Amazon, Walmart, which are integral to the success of countries like the United States, it's likely that this is very reliable, especially if you stake your money, it's low volatility and you hold for a long time. But next, this deals with the comparative then that they force us to defend weird things like the stock market in general, Binance, and cryptocurrency. We don't have to defend random bonds and hedge funds with no direction, and Binance is not counterfactual whatsoever. Okay, maybe the proper names that we use tends to be Binance, but that's because that's what we see the most. But the new ones, again, is the retail industry, which is too big to fail, and the companies are like big, safe, and reliable. So about the comparative of like loan sharks and crypto, this is where they really lose the debate because they never respond to this, right? Because we told you that affirmative, they're likely to do this from the start, right? Because there's this inherent urge to try to get rich or at least earn something with their passive money. And they try to say, no, actually the alternative on affirmative is not loan sharks. It's because of they go to the banks. But in reality, they never address the heart of our characterization, which is that people want riches one way or another. And banks cannot even come close to that with their really low interest rates. So yes, in the worst case, we don't completely address the desperate need of people to get rich, but comparatively, we do it so much more, exponentially more. 10 to 15% compared to 0.5% is still so much more, and it's enough to satiate these people when they know that the chance of losing it all doesn't matter much. This is why we prove that, again, on their side, they go immediately to loan sharks, and on our side, in the worst case, it's when they fail. But if we prove that they don't fail to begin with, then we win that. Okay, so the rest of this speech, I'll just deal extraneous with the responses. Again, about get rich fast, they're debating the industry as a whole, not engaging on the nuance of the rise. So we flip all of those arguments on them, actually, because the get rich fast and the scam ads are mostly filtered out by the rise. The fact that there's more companies competing over the same demand and there's more education about scams, the terms and conditions are more front and foremost. If you actually click on that Binance thing about $500 free, if you look at it, it'll immediately show you the terms that it's not actually free $500. So a world without the rise is where the government information campaigns don't exist, where all the regulation doesn't exist, all that kinds of things. And lastly, about this very catchy line, which is that you become the meal of the people. I still don't understand with the mechanization how you become the meal of the people, because we told you no matter how volatile or predatory or profit-oriented Binance is, one, they take a cut from every transaction. So if they become the meal and get off the platform, then they won't do any more transactions, and that's bad for Binance. More importantly, if there's dedicated supercomputers that trades, one, people can copy these trades. It's that easy. Secondly, they need to pump the stocks to get returns, and everyone can sell there and at least have a chance. Comparatively, it's completely inaccessible on affirmative. They can't prove the comparative is any better. Thanks.
I thank the negative reply speaker for that speech, and I would like to invite the affirmative reply speech to conclude the debate. Here.
Just confirming if I'm audible.
Yes, you are.
All right. Sorry, hold on. Starting my speech in 3, 2, 1. This is a timeline problem. Should you learn investments before you make them, like in affirmative, or should you invest first and learn later? I think Neg's world festers trial and error when every mistake for a middle-class person is a misstep into inferno. Every crisis in the financial sector is from industries that are too big to fail. I'm unclear with the retail industry, for example, which is very random for them to run because it's just retail investments, are the best actors in this particular debate. First on access and second on information. Firstly then on access. We said that the state is allowed to hedge risks and to prevent people from accessing something if the greater societal interest is for you to be cautious against these particular circumstances. Their pushback was, the risks are very minimal and things like that. But I'm unsure why in the world of like market volatility, for example, these risks are able for you to hedge on your own, but at the same time, why you're likely to compete against large corporations who are likely to buy off stocks and who are likely to manipulate the market because of information asymmetry. We said then against this idea of financial independence, but this is far worse specifically if there's a rise. One, the people left in traditional jobs get oppressed. As far as I know, this is a general debate, so they can trade this off. Two, the market gets manipulated because of perverse incentives of hedge funds, of large corporations who buy off these apps to tell to people and their consumers that you have to fund these stocks instead of the other stock like Jollibee or McDonald's. Three, corporate accountability, which was built from Upwip, is far harder because you have a gajillion accounts to monitor instead of our side where it's just two. It's easier for the state to step in and intervene in antitrust campaigns, for example, when there are less corporations, when there are less accounts, for example. Third level of this issue, retail investments on our side still exist according to NEG, and I'm pretty clear that, we agree about this. We just don't buy the lie of DLO that infrastructure won't be there. Because again, the state is there to tell you to save up first and climb upwards before buying a bond. Upwip then responds by saying, banks are still private, yeah, but the rise means on their side, people had to massively withdraw large amounts of money in order for all of their benefits and opposition to materialize, which means that you cripple some of the smaller banks, like agricultural banks on their side of the house, which still trickles down to the harms they talked about, which they brushed off. But then Upwip also builds financial independence, returning to these idea of investments. One, again, the market is volatile. The argument that, some people can earn periodically, we have to question who will earn periodically. Those people with supercomputers, those people who are rich, who are also buying from Binance. So that is a harm actually on their side. Two, Upwip thinks anti-work is a benefit because of contingency plans. But again, this lowers economic productivity, you lower working conditions, and UpReply even says it's passive income. We framed Axie Infinity to coexist with this rise, specifically being very convenient for you to opt out of your job and just play games to earn income, which we think is very, very bad. But then they argued incentive to regulate is still there. I'm unclear why capital flight does not exist. If I think that Binance, for example, is now very regulated, why will I just not go to other more lucrative, like more market-free sectors like England or Hong Kong? Next, then on information, because I'm pretty clear that the access thing is null and void on that side. Upwip ignored GovWip's response about Robinhood's interest to bury narratives of failure and saturate marketing with narratives of success. No one will buy investments from Robinhood if they know that it's not attractive, which means that it highlights that there are pernicious incentives of these applications that they never responded with. They concede that this is low reward investment, then they're still prone to loan sharks. UpReply builds this about competition, but now the state needs to compete with 50 companies for perfect financial literacy information. I'm unclear why this is a benefit from the argument of UpReply, but they also had a one-dimensional frame of how these apps work. They just say they want to teach you, but that's not the only way that they have very good profit margins. We talked about targeted ads. We talked about hidden brokerage fees, pernicious ads that entice you to invest first, learn later. Regardless if you're middle class, you're not from Wall Street, you will not know how to interpret that very good graph of the X and Y axis. So one, if you can just rely on the graphs of Instagram and Robinhood, then what's the use of literacy that's like opposing on that side? Two, sure, you inform them about the ins and outs of this company, but you never inform them what bad things they have to be complicit with because they're still essentially funding them. But imagine again, the rise specifically means that there's massive subscription, millions of people to teach individually what the risk appetite is. That is not very lucrative for Binance. I would rather just keep people in the dark and learn that some people have to suffer in order for the rich to gain access to the upper rungs of the heavens.